So we are excited to kick off our panel on sustainability and IFC's operating principles for impact management. I am joined by Neil Gregory, who is a chief officer at the IFC, and Herve Duteil, a chief sustainability officer of Americas at BNP Paribas. So welcome today to the panel.
Thank you. Good morning.
Let me start with Neil. In terms of, if you could just spend a few minutes just kind of explaining what is the IFC's operating principles for impact management and how that framework is potentially channeling trillion into impact investing.
Great, thanks Scott, and good to be with everybody this morning. I think we've all seen how interest in how our assets are invested has grown over the past few years. People are more concerned about their money is making a positive contribution to addressing climate change, to addressing inequality and social justice, to achieving the global sustainable development goals. And so we see financial markets responding to that by launching more products that are labeled as sustainability or impact or SDG or climate. And this is great. We think that there's real potential for private capital to make a huge contribution to addressing social and environmental challenges around the world. But that interest also comes with a challenge, which is, how do you know that when you put your money into something with an impact label or sustainability label, how do you know that it's really going to be managed in a way which will contribute to achieving real and lasting impact? And there's a lot of concern in the market about impact washing and sustainability washing. And so this is the challenge which we're addressing through the operating principles for impact management. These are a set of principles which basically describe the key things that an investment manager should do at each stage of the investment cycle in order to integrate an impact objective alongside a financial objective in the way that they manage capital. And so there are 8 principles which go all the way through the investment life cycle. And then we added to that a 9th principle, which says to give comfort to investors and to avoid these concerns about impact washing, you should publicly disclose each year a description of how your impact management system follows these principles. Plus, from time to time, you should have some independent verification that confirms that you're actually doing what you do in the disclosure statement. So these principles were launched almost exactly 2 years ago. Our 2nd anniversary is coming up on April 12th. We launched with nearly 60 signatories from around the world, including BNP. And as of today, we now have 127 institutions, funds, banks, development finance institutions that are now following these principles. And what that means to you as an investor is you can go to impactprinciples.org and actually read the disclosure statements. If you want to know how IFC manages our capital for impact, you want to know how BNP manages capital for impact, all these disclosure statements are publicly available on the web now for anybody to review. So this is bringing a level of transparency and discipline, which is what's needed to really continue to attract more capital to this space. We think already there's about $500 billion that's being managed in accordance with the principles. We think potential for that to go much higher. We have a steady stream of new fund managers and asset managers and banks adopting the principles. So we see real momentum behind this part of the market, and we're glad to contribute to making sure that it grows in the way which is transparent and disciplined.
That's very exciting indeed. We're going to come back to the reporting and verification in just a few minutes. I want to ask Herve, in terms of your role at BNP Paribas, and share how the bank is thinking about sustainability.
Sure. So my vantage point is more the investment banking division as opposed to the asset management division of the firm. So my lenses are more through what we call really the financing of corporations, and that in turn creates securities, which eventually asset managers, asset owners buy and put into portfolios. So it's the other end of the spectrum, but for us, what we've been striving at over the last 7 years has precisely been this: looking one client at a time, one transaction at a time, and trying to create incentives for treasurers when their corporation works on sustainability progress. So this has gone 2 generations of project. The first one was, the first discovery in sustainable finance was that the moment you stop labeling the use of proceeds, starting to label the use of money, whether it's green, social, SDG, sustainability, gender, rhino, pandemic, bonds, COVID-19 response bond. I mean, as soon as you start putting a label, which in the private sector we started to do at the late 2013, you uncover pockets of money that were not that obvious, even within existing large fund and asset managers. You may have the regular funds, but you also have the sustainable bond fund and many other pockets of money. So that was the first step, and actually going in the line of what the IFC has done. Initially, investors were happy with the labeling of use of proceeds, but then they were demanding for impact measurement. They were demanding to see some reports over the years of what has been the impact of that use of proceeds. Okay, you said you were going to build a wind farm, but can you measure and let us know about the CO2 emission that have been avoided and so on? So this is the first step. The second generation of product has been in 2016, 2017, when we started to link interest rates with sustainability performance in the future. So these are the so-called sustainability linked products. It started in supply chain financing, and then it moved into loans, sustainability linked loans, and then in bonds, and then in derivatives. And if you think about it, it's quite revolutionary. For thousands of years, we lent money on the basis, simply on the basis of the ability of the borrower to repay. And for the first time in history, we also index a small portion of that interest rate to the ability to do good. Of course, we believe this can have financial impact in the longer run. But so linking more closely interest rate with the realization of some sustainability targets, whether it's, again, greenhouse gas emission targets in year 1, 2, 3, or whether it's getting 30% of women on board of the corporation or any other metrics. So this wave of impact measurement has also been progressing at the level of the individual financing, and we're getting into a trend of greater disclosure on these, which in turn are useful for asset managers to abide and fulfill those principles that the IFC has so well formulated in their operating principles.
Well, I think it's fascinating that this notion of sustainability has become part of the calculation, the modeling into the interest rate. And more so than, whether it's structured as a benefit or in some cases as a penalty, is that in addition to maybe losing that portion of the interest rate that was tied to sustainability goals, is really the reputation risk of not following through. And perhaps that has a greater damage effect than even the loss of a small, basis points. What are your thoughts?
I think it's I see the importance more upfront than afterwards, to be honest, in the sense that we're moving to a stage. I mean, clearly the last 18 months, sustainability has blossomed on the universal stage, and everyone speaks about sustainability, and everyone is making commitments every other day. You read a net zero commitment coming up, etc. And sustainable finance offers in the last few years, we were more focused on the opportunity side, and obviously those who use sustainable finance tended to be the best in class, and so those who were more likely to reap the benefits, of that beneficial interest rates. But now it offers you an opportunity to put your money where your word is. With so many commitments coming up of being net zero this, or reaching this target, or swing to this goal, now the proof can be in the pudding, where if in line with your commitment, you commit to a financing where you may lose money if you actually don't achieve the goal publicly committed. I think it's even upfront, before we even get to the result, it's an opportunity to really put your money where your word is and demonstrate the seriousness of your commitment, that it's just not an aspirational goal, So
we've been talking about proof to being able to empirically show the follow through on the commitment. So Neil, I want to ask you, in terms of standardizing disclosures and reporting, what's been done so far, and what is IFC and others working on to help harmonize some of these disclosures and reporting requirements?
Yeah, thanks, Scott. I think this is a very important space. I agree with Herve. I think one of the most exciting trends in the market now is shift from the first generation of green and social bonds, which were just tracking use of proceeds, which in some ways is easy to narrow, but it's a very easy to measure, but a very narrow way of thinking about impact. So these sustainability linked structures where you're looking more at the overall impact performance across the firm, not just the use of proceeds. But that brings with it the challenge of having consistent metrics that, and we've seen in the ESG space that having lots of different metrics which don't line up with the challenge of users, investors, and undermines credibility in the market. So I think it's extremely important that we converge on common metrics. And I think that climate change is probably in the lead on that because it's such a pressing issue. And also in some ways, the key metrics lend themselves to quantification. A ton of CO2 is something you can really get your hands around. What we've seen over the last year, I think, is that, although initially you had a lot of activity in green bonds, there's a lot more activity on social bonds and sustainability linked bonds, more social targeting, and there it becomes more challenging to measure impact. So what we've been doing over the last year is working with a group of like-minded investors to try and converge on some common metrics that we can use to report on three key impact themes. One is climate, one is jobs, job creation, and one is gender. And the climate metrics very much build on frameworks like TCFD, which are used by a lot of investors. The gender metrics build on gender programs that have been supported by the US and European investors. So there is actually now a real sort of drive towards convergence, and it's starting with the investors. And so we have 50 leading investors joined us in endorsing this first generation of joint impact indicators just last month, and we expect to build on that. But what's exciting now is that at the same time, there's real momentum in terms of corporate sustainability reporting. Now, at the end of the day, investors would much rather that corporates were routinely reporting on key sustainability metrics, and we can use that reporting to measure our impact, than having to go for custom data, which they're not routinely reporting on. That's much more burdensome, and both for the investor and for the investee company. So I think the most exciting development now is that IFRS, which has been the global body setting financial standards around the world, has now announced its intention to create a sustainability standards board. Now, that could become just another set of initials to add to SASB and GRI and all the existing attempts to organize corporate reporting. But I think what is exciting about this is that there's a real sense of these other reporting frameworks coming together and converging and saying, yes, IFRS is the right body to bring this together. And the same with these joint impact indicators that we're developing from the investor side. We hope that by clarifying and aligning ourselves, being able to speak with one voice of what are the key impact metrics that we and investors want corporates to report on, that will help shape this corporate reporting agenda. So I think there's real momentum. We're going to see some real progress over the next year in this area.
So I wonder, from some of the leading work that you're describing to the way it's actually getting internalized within, let's say, Wall Street, for example, in terms of a continuum, is you mentioned that if it's not properly kind of standardized, that it becomes kind of an ad hoc set of, pulling out reports, let's say. So what are the kind of best practices or thinking around, and again, this is for both of you, around how can these indicators, impact indicators, as well as metrics, become just a regular ongoing process, and in some ways even systematized, so that the ERPs and the cloud systems are automatically, to some extent, capturing it, so you can pull it out in a kind of an on-demand versus, painstakingly having to go through third-party auditors and manually sifting this information out.
Neil, if you want to start, I have two. A bigger picture.
Go ahead.
Go in the details first. Otherwise.
All right. Let me go on the details first. So I think part of the operating principles for impact management calls on investors to set up the impact metrics again to track when an asset enters the portfolio, and then to routinely track during the life of the portfolio and report at the end. So I think that many fund managers, asset managers are putting in place now the systems to do that on a routine basis. I think that the more we converge on common definitions, then that will enable the reporting to then be able to be used by asset managers to look across a portfolio of impact assets, to be able to actually add up at a portfolio level, which until you have the common definitions is hard to do. But if you look at the market today, I think there are still two gaps that we need to fill. One is that there's no sort of common format in which people report. You get everything from very sort of fluffy marketing, storytelling type of reports to much more detailed reports, but without any sort of consistency. From the asset owner perspective, it's still quite hard to actually read the impact reporting and make sense of it across different investments. And the second thing is actually the assurance of the quality of the data. So all the impact data that we report in our IFC annual report, we have assured by our auditor. That's not yet common practice in the market. And so there's lots of questions about the quality of impact data. Again, it's early days. And so first you have to put in place the systems to capture this data. But then I think the next step in building confidence from the asset owners is going to be to then put in place quality assurance and auditing of the quality of the impact data. But that path I see us going on.
Yes, the two bigger picture ideas I wanted to complement with. The first one was in sustainability, you often have the conflict between the simple and the complex. And you have those who advocate for simple measures, standard measures, just have 10 numbers. And you have those who advocate for, let's have a tailored approach, sector by sector. You can compare an oil and gas company with an agri company and so on. The same way when it comes to mandatory disclosures, you have those who advocate just mandate disclosures to all companies. Others are going to say, no, just do it for public, large listed companies, but not the private. And the truth is, everyone has good arguments. But the reality is we have an urgency. Yes, maybe we should take time, for example, on mandatory disclosures, do it right, and include companies in 5 years' time when we've progressed on how to disclose. The reality is we have only 10 years to act to make this 30-year target, and we can't wait for 9 to make the right decisions. We need to have more or less all the tools, even if imperfect, within 2 to 4 years, I would say, to have a chance to make the right decision by 2025 and really change course by 2030. So the same is true in impact measurement. I think having some common metrics is very important so we can aggregate, so that asset managers can aggregate their entire portfolio along some simple metrics, all imperfect, and that we can compare also asset managers among themselves globally. So that's the first thing, is there are very valid arguments for both tailored approach and simple ones. The thing is, the urgency forces us to go first for the simple and simplistic, I would say, and add on. The second thought was around data. I think last year we had the COVID-19 crisis, which we're still in, but it's the first sustainability crisis of this century, basically. And every crisis creates a revolution in some ways, and especially triggers new needs around transparency. The 1929 crisis created the need for transparency around profits, and that's how the SEC came up, etc. The 2008 crisis created the need for transparency on banks' leverage. I would say this current crisis has created the need for disclosure, for transparency around impacts, on environmental and social impacts. And with each of those crises, each time you had a technology that gave you a solution. So at the time of the 1929 crisis, the technological solutions were auditing firms. In 2008, it was more Monte Carlo simulations, I would say. for this crisis and this need to fulfill transparency on social and environmental impact, we have something we didn't have 20 years ago, which is data, which is big data, which is artificial intelligence. Granted, it has to be formalized and organized, but today we have the technology we didn't have even 10 years ago to measure environmental impacts.
Well, I think between the both, there was a lot that was covered. I want to go back to first the formatting, and I think when Neil, you were referring to format, it's not just simply the true format of what that disclosure looks like, but rather the metadata, the underlying sets of business objects, and the data that's actually getting reported, and some level of harmonization, standardization across within sector or across sectors or rolled up to a portfolio or whatnot. So that's one issue. And then the verification and the assurance aspect, which again, I think this is another boom opportunity for auditors, financial and accounting, in terms of extending their capabilities to assist with the formatting aspect, but also the assurance aspect. But even with all those things in place, I think there's always going to be some loophole. I think there was a mention of data and artificial intelligence. Is that I think especially in the case of AI, for instance, there are, some of the challenges we're dealing with is kind of a black box where, yes, we understand kind of the raw data and the source of the data, but the way it was actually derived from an algorithm and output, there may be a little bit kind of opaqueness. So, how do we actually start to, even if we formalize these standards, metrics, formats, and so forth, and have assurance, is that enough? Or are there other things that we can learn from prior experiences around some of these things? That's one question. The second question really is around this notion of urgency that that was brought up by Herve, which is, I think whenever we talk about standardization, we think about kind of thoroughness, completeness, right? And part of that means kind of inherently built in this kind of elongated time frame. So how do we, reconcile this, need to be comprehensive, thorough, perfect, mitigate all the risks, but yet still be making significant progress in the next 3 to 5 years?
On the first question, mostly, if I can start answering that one, I think it goes back to what I was saying on the battle between the simple and the complex. Yes, it takes time to achieve perfection, and we cannot afford taking that time to wait and start something. And I'd like to give you the example of a very large pension fund in Canada, which I will not name, but they committed publicly to reduce the carbon intensity of their portfolio by a substantial percentage. And the question is how you measure that, because you have a variety of data sources. And they decided to just pick one. They just picked one provider. You have a great disparity between providers, and they said it doesn't matter. It doesn't matter whether it's right or wrong. It just gives you a baseline. You just measure your entire portfolio against that baseline, and you know the progress you have to make. And the error, the loopholes you were mentioning at the beginning, in my perspective, it's true, but they are at the periphery. They are at the margin, and that's where again we need to focus on what's simple. Let's forget the imperfection. The imperfection should not prevent us from moving forward.
Yeah, I agree with Herve's sense of urgency, and not let the perfect be the enemy of the good. The perspective, I would say is that we know that trillions of dollars need to be mobilized to invest in the climate technologies to achieve the sustainable development goals. Whether you look at surveys of retail investors, whether you talk to pension funds and other asset owners, they're ready. They want to invest in this stuff. They're saying, give us the credible investment opportunities. So, for me, the key to all of this stuff, whether it's the impact management principles or whether it's the metrics, is being able to put something credible in front of an asset owner that gives them the comfort level to actually put their capital to work. That capital is sitting there ready to go to work. The challenge to all of us is being able to put it to work. And all of these frameworks and things that we're talking about, these are all just tools to solve that basic problem. How do we get asset owners comfortable that you're going to deliver sustainable impact?
Well, at this time, I want to open it up to the investor community to ask questions. If you have a question, please go ahead and raise your hand by clicking on the raise hand button on the right, and we'll bring you onto the stage. In the meantime, while we're waiting, And I think, Neil, you started to kind of address this around kind of asset holders. So when, again, both of you are coming from an institutional and NGO side, but for the rest of us that are on the, let's say, the individual or the retail side, how can we, as individuals participating in, let's say, company pensions or life insurance as policyholders, or investors in mutual funds and ETFs, how do we start to individually, but also collectively flex our muscles so that we can actually start to really make this happen and accelerate some of the momentum that both of you are building?
So I think that's a great question. And, asset managers, they're required by law to basically serve the interests of their beneficiaries, whether it's pension holders or insurance policy beneficiaries. For a long time, people interpreted that as meaning, well, that just means I have to maximize the financial return for my beneficiaries. But actually, if you as a pension holder or purchaser of an insurance policy, if you care about building a sustainable world in the future, that is something that a fiduciary should also then be managing for. And so I think it's incredibly important that people use their voice with the asset managers and the financial institutions that are putting their money in, to actually tell them that you care about this stuff and this matters to you. In markets where people have a choice of where to put their pension assets, if you look at the UK, if you look at Australia, then there's evidence that people move their assets into those pension funds where they feel that they're going to contribute to a sustainable future, not just a financially comfortable future. Where we've seen this in the US, that where asset managers, for retail investors, where they put in their offerings something with sustainable impact label, immediately you see big shifts in the way people allocate their money. People are looking for these opportunities. Asset managers are sometimes hesitant to offer them because they, particularly those who are bound by fiduciary rules, they need to know this is something which is actually clearly can be shown to be in the interests of their beneficiaries. So there's an important role for all of us as retail investors in the way we manage our money to signal that this is something which we want our money managers to be delivering for us as well as financial returns.
Well, let's see. We only have about 10 seconds. Herve, did you want to have a final comment?
No, I was about to concur that the forces come from the bottom and the top, actually. From the bottom, the retail, if I may say, has been active every day. And just this week, you read of the creation of ETFs on the transition economy, or another one in Europe on the just transition. I mean, if asset managers are offering those products, it's not because of demand. It's quite the opposite. So expressing your interest is the first step. And the top was on top. You have also a convergence of influence to regulate the labeling of funds, especially, for example, in Europe with the SFDR, the Sustainable Finance Disclosure Regulation, trying to put some framework around.
Thank this panel.